Markets failed to sustain opening gains in this last week of 2025. Nifty slips below 26,000, dragged by IT and financial stocks. Metal stocks bucked the trend, outperforming the gains ranging between 2 to 10%.
There's no stopping the silver sparkle. The precious metal surges past the $80 mark before witnessing some profit-taking in Asian trade. Gold prices cool off 0.25% on hopes of a Russia-Ukraine deal after talks between President Trump and Zelensky in Florida.
Coforge trades slightly lower after its mega AI acquisition of Encora for a $2.35 billion. Brokerages retain positive stance. Kotak says Encora is a good asset, but pricey. Morgan Stanley calls it a bold move, but adds that earnings may get diluted in the near term.
Timex is under pressure as the parent is set to sell another 9% stake in the Indian entity via OFS. Meanwhile, John Cockerell surges after the promoter sells 5% in the open market. Veteran investor Ramesh Damani picks up 0.5% via Blocktail. Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a very quiet session as expected. So we just about have the Nifty, which is lower by around 70 odd points. It is below that 26,000 mark. We have the mid-cap index, which is under pressure as well. So it's underperforming, down around 0.4% nearly currently for the mid-cap index. The advanced decline ratio could be wanting for more. So we have around 1,600 stocks advancing to over 2,500 stocks, which are declining on the Bombay Stock Exchange at this point in time. A couple of the metal stocks are managing to hold up at this point, doing well in today's trading session, reflecting maybe the optimism that we're seeing in the precious metals market as well.
Absolutely, Ekta. Good afternoon. While obviously metals are not losing their sheen, let's pull up Nifty PSU Bank. Seems like that's moved on the green side as well. It was not holding on to green in the morning trading session. So now again back to the green. So that is something to watch out for. But apart from that, a lot of individual movers, right? And Ekta mentioned those metal names. So we have Hindustan Copper, Hind Zinc managing to hold on to very strong gains, while strong volumes also are seen in HFCL, MMTC, some of these names that are buzzing around. But NSE has announced the introduction of F&O contracts on 4 stocks, and this is with effect from December 31st, 2025. For more details on this, let's go across to Sudarshan for this.
So come January 2026 series, you'll have 4 new stocks being part of futures and options contract, while 4 stocks which are currently part of F&O will make an exit. Those stocks which would be excluded are HFCL, NCC, Titagarh Rail and Cyan. New 4 stocks that will be part of F&O effective December of 31, and those are Swiggy, Vari Energies, Premium Energies, Bajaj Holdings and Investment. And most of these names have been making moves over the last few trading sessions. So first, I'll talk about those stocks which will be exiting F&O, and the first on the list is HFCL. Company has recently completed fundraising of more than rupees 550 crore via QIP, and today also the stock is sharply higher. At one point the stock was up as much as 9% and currently hovering around its QIP's floor price that was around 65.84 rupees per share. And if you talk about this series move, it's down 6%, and this year, that is in 2025, stock has been one of the biggest underperformers if you talk about all the mid-cap names, and has fallen as much as 41%. NCC, which has reported a weak set of earnings for Q2 FY26, even had trimmed overall guidance for FY26. And this month, in this series, that is of December 2025, like HFCL, this stock too has fallen 6%. And in 2025 too, this stock has fallen as much as 41%. Titagarh Rail, this in the line of all the other rail companies, basically have been seeing all the major moves ahead of budget that we have next month, not next month, basically in the Feb 2026. This Titagarh Rail also over the last few trading sessions has seen a sharp up move, but in this series, that is in December of 2025, the stock has moved 9%. In 2025, overall, in the year, the stock is down 18%. Cyient has been biggest underperformers if you talk about all the IT names, down 41% this year and down 3% this series. Stocks that will be part of FNO from December 31, Swiggy, and that would be, it's being included after 1 year of the listing. And at one point, the stock had fallen below rupees 300 per share. That was after Q1 FY26 earnings. But it's up 5% in this series and down 26% in 2025. Wari Energies, Premium Energies and Bajaj Holdings have been down in the range of 3 to 11% in the month of December 2025. And these three names will also be part of FNO from December 31.
Okay, all right, Sudarshan, thanks very much for that. So that's the entire FNO rejig that we can expect. But we do have Vivek now to take us through all of the stocks that are moving around in trade at this hour. Vivek, over to you.
Well, thank you so much for that. It's been a very volatile trading session, although a thinly traded one, especially in the broader end of the market. Volumes are quite dry. In terms of individual names, individual sectors, like you mentioned at the start of the PSU banking bank actually made a bit of a comeback. In terms of individual names, HFCL, that particular stock has highlighted, surges ahead of the FNO exclusion. Vikran Engineering, last 3 to 4 days, you've seen continuous order wins that this particular company has managed to bag, stock higher by over 3%. Hindustan Copper, can't skip this particular name, higher by over 9%, top gain on the NSE 500, and copper prices as well as other metal prices continue to surge as we enter year end. And lastly, have a look at some of the names, proxy plays as far as the metal plays are concerned. So names like HEG, Graphite, as well as Rain Industries, aluminium smelter capacities worldwide will be in focus. All of these names higher by over 4 to 5%. And ahead of the Defense Acquisition Council meet today, whole host of defense names, shipbuilders are in focus. Most of them are pricing in a little bit of optimism, doing quite well. Shipping Corporation, Mitra Dhatu up almost 11%. Zen and Paris have cooled off in the last hour or so. On the other hand, quite a few laggards as well. Can't look beyond Timex, an OFS has been launched, further pairing of stake by the promoter entity, that particular stock at the lower circuit. Have a look at the entire railway pack. All of them last week, up anywhere between 15 to 25%. Today, most of them are seeing a little bit of profit booking come about. RVNL, Rights, IRFC, all down anywhere between 3 to 4.5%. KNR Construction, the top NSE 500 laggard, decent volumes over there. And Anantraj, again, high volumes, one of the top laggards as far as the broader end of the markets are concerned.
Okay, Vivek, thank you so much for listing out all the stocks that are moving around in today's trading session. But on that note, we're going to slip into a very short break. After the break, we'll talk about Coforge, as they've made that big announcement of the acquisition of US-based engineering service company Encora for $2.35 billion. We'll talk more about that on the other side. Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty is still below the 26,000 level. 25,985 is what the Nifty is at. So just almost near the day's lowest point, down 60 points as of now. But let's talk about Coforge. Coforge has announced acquisition of the US-based engineering service company Encora in a $2.35 billion all-stock transaction. The annual revenue of the combined entity will be $2.5 billion, and the management calls it a defining moment for the company. But is the deal too expensive? Rima is joining us to give us more details on this one. Over to you, Rima.
Thanks so much for that. I think that is the big question everyone is asking. Is this deal between Coforge and Encora expensive? Well, the short answer is it's a good asset, a great asset, but perhaps a tad bit expensive. Now, Coforge is paying $2.35 billion for Encora. This is a company with estimated revenues of $600 million, which means the acquisition is being done at an EV to sales of 3.9 times. Now, putting that in context, most global digital engineering companies today are trading in lower multiples. Now, this I picked up from a Motilal Oswal report where they're saying a company like EPAM is trading at 2 times sale. Globant is trading closer to 1.3 times. And even some of the recent M&A deals were cheaper. Now, Cognizant acquired Belkin last year at roughly 1.6 times EV to sale. Infosys bought Intech at about 2.6 times sales, which raises the valid question, has Coforge paid a premium? Especially when you see it in context, analysts point out, to Encora's organic growth, which is slow to 7 to 8%, while Coforge itself has been growing much faster at mid-teens. Now, JM Financial summarizes by saying the valuation looks rich given Encora's 7 to 10% growth profile. Now, moving on, when the price is high, there is also very little room for error. So what are the risks? Well, I can see three of them. One is integration risk, because this is a very large acquisition, the largest done by an Indian company. Encora is more than 30% of Coforge's size compared to their earlier deals like SLK Signity, which were smaller. So when there is such a large asset, integration is not the easiest. Secondly, the management is also guided for the acquisition being EPS accretive by FY27, but this requires flawless execution. The second risk is dilution risk. It's an all-stock deal leading to 21.25% equity dilution for the existing shareholders. And on top of that, Coforge has the option to raise an additional $550 million via QIP to retire the debt. As of now, it's not decided by the management whether they will flex that option, but it's still an overhang. And the third one is the overhang from private equity investors. Encora shareholders will hold about a 21 to 22% stake in Coforge, and 50% of this will unlock after 6 months, the remaining after 12 months. Analysts say that this is a potential supply which will cap the near term. But it's not all negative. There are some real positives here. Now, post-deal, Coforge becomes a $2.5 billion revenue company with EBIT margins of close to about 14%. The management is calling this a defining moment in Coforge's journey. And there is a clear step change in the company's capability. Encora brings AI-led product engineering, and the combined company will have nearly $2 billion of AI-linked revenue. The deal also opens up high-growth white spaces for the company like high-tech and healthcare, and the revenue synergy potential is significant, especially through cross-selling, and Coforge does have a very strong execution and an M&A track record, which gives the street some comfort. From a stock perspective, just over the last couple of days, the stock had declined close to about 10%. So some of the concerns are being addressed. But other than that, it's been such a wealth creator. Its 3-year revenue run rate is, the stock price return is 120%. In the last 5 years, it's more than 1,000%. So it's a bold, transformational acquisition by Coforge, and now it's up to them to deliver on that.
Okay, all right, Rima, thanks very much for that. Let's in fact hear out what the management had to say about the acquisition.
The acquisition of Encora is a defining moment for our organization. And I mean a defining moment. Born in the Silicon Valley, California, Encora is one of the select technology services firms with an AI-native DNA that provides software engineering services for digital native companies and Fortune 1000 enterprises. Encora works at the convergence of AI, cloud, data, with service offerings that span intelligent process design, agent-native product engineering, core modernization, AI foundation, data readiness, and AI ops.
From financials perspective, the consolidated turnover of Encora Group for financial year 26, the estimated number, and they follow April to March financial year. So estimated number for financial year 26, revenues are around $600 million. And adjusted EBITDA of the firm is 19%. With Encora's current margin profile and the anticipated synergies that we see in the business, and the combined business is expected to operate an EBIT margin of 14% post amortization of intangibles that will be created as part of the purchase price allocation for this acquisition. Despite the primary infusion, the deal is not expected to be EPS dilutive on a consolidated basis because of the strong margin profile of Encora and expected synergies from the two businesses, that is Coforge and Encora, coming together.
Let's also listen into some of the expert opinions on this deal as well.
Encora is a good company. They have good metrics. As I said, the growth looks good. Even the margins look pretty good. But ultimately, the model is going to have to adjust for this new era. And that's going to take some time to get there. The AI model, as I said, is going to have to really kind of reinvent the traditional model in tech-enabled services. I think for the true Gen AI companies, you probably have to pay a much higher multiple than what they paid for this one. So I think they, for what they were willing to pay, they probably got a pretty decent deal.
I believe that you have to do strategic things, and from that perspective, Coforge has probably gone and done this. But there is a very limited story of successes in such kind of acquisition, particularly as Rima mentioned, the integration risk, the execution risk are too high. One good thing in the deal is obviously it is an all-stock deal, so everyone's outcomes are completely connected. So I think from that perspective, it is very good. They are very, very good. They are second to none. So I also have a lot of confidence in their execution capability.
I mean, it's the second large acquisition in a very relatively short time, and I think I agree with the comments that it's a very expensive, stock. So and growth rates overall. I mean, obviously the companies like Coforge are growing at a faster pace than the large cap IT. But still, I think one has to be very careful with the valuations at this level. So I mean, I think one of the key metrics that we track is of cash flow yield. And we can look at operating cash flow yield if there is a big acquisition. But cash flow yield is also, operating cash flow yield is also very low.
Okay, all right. So that's the view coming in on Coforge. Remember that stock is managing to hold up with a gain especially post the conference call details where the street got more confident in terms of the acquisition, though it is going to be a large size acquisition for the company. We'll take a short break, but up next, Mehul Kothari will join in. He has some trading ideas for today. Stay tuned. Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Just watch out for a couple of these stocks on the upside. So MMTC is showing good amount of traction today. That stock is up around 7.5%. We have HEG, which is up around 6.5% at this point in time as well. And we have Rain Industries, which is gaining as well. So up around 5.5% for Rain. That should come up for you. So good traction, which is coming into specific stocks. On the downside, just watch out for IRFC. So that stock has seen a little bit of pressure and it continues today. So that stock is down around 4% odd. RVNL also from the rail space is showing pressure. So that stock is down around 3.7%. We have KNR Constructions, Asahi India, all of these stocks which are under pressure at this point. So some amount of red on the screen. But let's go across to Sudarshan now. He joins in to tell us what he's tracking in the F&O space. Sudarshan, over to you.
So ahead of the last expiry of 2025, it looks like that market has gone into a sleep mode. Has anything changed in the last 1 hour? Well, the answer is no. Market has slipped to days low. Nifty remains below 26,000, and for the Nifty options, 26,000 is acting very important level both on the call side as well as on the put side. On the call side, we are seeing a big increase in the open interest while premium has seen a sharp fall, while on the put side, the contrast movies premium has risen. Similar trend is being seen for Nifty Bank, and that option, that strike rate is 59,000 both on the call side and the put side. It's a very active option. So for Nifty, now the range is 26,000 to 26,200. It's very unlikely that Nifty is going to expire above 26,100, or maximum it can go up to 26,200. For Nifty Bank, now the range has become 58,800 to 59,200. So support for Nifty, 25,910, that is 50-day moving average. Resistance will be 26,140. For Nifty Bank, support will be 58,700, that is 50-day moving average. And resistance will be 59,270, that is 20-day moving average. Some of the stocks are seeing fresh longs from the metal pack. Tata Steel is one stock that is seeing fresh longs. One stock from the OMCs, HPCL, is seeing fresh longs. And two stocks that I have taken that are seeing fresh shorts are Persistent and Petronet LNG.
Okay, Sudarshan, thank you so much for the update in the world of F&O. On that note, let's bring on board now Mehul Kothari, Deputy Vice President Technical Research, Anand Rathi Shares and Stock Brokers, to talk to us about the technicals. Mehul, good afternoon. As of now, today the Nifty is moved to the day's lowest point below 26,000. What should one keep an eye out on this week in terms of the levels? And if we don't close about 26,000, what would it mean then?
Well, good afternoon, many thanks for having me on the show. There was a gap on the daily chart of Nifty, which was expected to get filled somewhere near to 25,950. And that gap has been filled in today's session. So Nifty has now retraced overall 61.8% of the recent rally, which started from 25,700 to 26,200, which is the recent top. So on the momentum front, what we are witnessing is early RSI is entering an oversold zone. So this indicates potential exhaustion on the downside. And we expect buying interest to re-emerge from the zone of 25,950, which is the current level, to 25,850. So this 100 points range can be considered as a buying zone for the fresh long positions. Overall, the key support for Nifty seems to be around 25,700. And as long as this level holds, the broader structure remains positive. Traders can consider even executing a bull call spread for the next week expiry if they want to participate in potential bounce with controlled risk. But overall, having said that, we feel that buying traction is expected to remain stronger in individual stocks rather than the index.
Okay, all right, fair enough. Mehul, what's your sense in terms of a lot of these metal stocks which are gaining? How would you approach them going into next year?
Well, we have been bullish, quite bullish on all these names, specifically Hind Copper. We have initiated by somewhere near to 200 in our Diwali picks a couple of years back. So we continue to remain bullish. In fact, one of my pick today also is from a metal pack.
Okay, and take us through the picks as well for today.
Well, first is JSW Steel. One can go long in the stock somewhere near to 1100 if at all it comes. So keep a stop loss of 1070 with an upside target of 1160. The stock has seen a healthy retracement from its recent peak and has shown signs of reversal after testing its 200 EMA. So this indicates a potential resumption of the uptrend in JSW Steel. Another stock which we want to discuss is, this is not a recommendation, but yes, Adani Ports we want to discuss because there are early signs of fresh weakness emerging in the stock. It is hovering close to a breakdown zone and below 1450. Some profit booking could be seen in the stock. So traders should closely watch this level for further price action. So Adani Ports, one should be watch out for, and JSW Steel, which we are bullish on.
A couple of these railway stocks which you've managed to look at, which are under pressure.
In railway space, we feel that this could be a buying opportunity, but today is the first day of this profit booking. So one should wait for a couple of sessions, let them cool down. And again, there would be a buying opportunity. Specifically, if we talk RVNL, which we are liking currently, it is 370. If it comes to 350, then the risk reward would be highly attractive to go long.
Okay. Highly attractive to go long. Wait out for the names coming in there in terms of maybe some correction or profit booking before you look at it as well. Mehul, do you have any view today coming in even on something like an HFCL? They see good volumes as well.
See, it's a highly underperforming stock, HFCL, if we talk about it's trading below its 200 EMA. So overall, the trend is negative. But yes, today there is a possibility of reversal because the volumes are quite high. And if it closes above 65, which is a strong resistance zone, it did cross it in intraday, but closing basis 65 is an important level. So if it closes above that, then there is a possibility of some pullback in the stock towards 70 or 72. Overall, the support is now at 60. Below 60, there could be further downside.
Okay. All right, Mehul, we're going to let you go on that note. Thanks very much for joining in and taking us through all of those calls. That's Mehul Kothari on the technicals. We'll take a short break with the news that the markets are just marginally lower at this point in time. But Manisha Gupta is going to join in. She has with her Amit Goyal of Pace 360. Stay tuned.
Welcome back. Joining us now is Amit Goyal. He's co-founder and chief and global strategist at Pace 360. Amit, hi. What crazy market this continues to be even as we are at the last end of 2025. I mean, look at the market since morning today, Amit, and silver has been moving in a range of $5 75 on the lower side to 81 on the higher side. What really is happening? I'm assuming this is all on the back of lower volumes, would you say?
Absolutely, Manisha. And I think, as we had discussed last time, silver has got completely unhinged from any measure of reality, any measure of fundamental. It has got disconnected from the dollar index, from the equities market. So I think this is what a bubble looks like, though you still can't say with 100% certainty that the peak has been made. While of course from today's top we are down some crazy 12% in just a matter of what, about seven odd hours. But my sense is that silver is probably as big a bubble as crude oil was in 2008, when in June, July of 2008, it made a high at $145 and it never went even close to that level ever again. I think all these noises around silver have now reached a crescendo. But I'm still not very, very sure that the peak has been made. Of course, definitely a correction has happened. There is a possibility that it may become sideways, but there is also a possibility that it may go down further from here and then come back again. I can assure you that silver's volatility is not going anywhere. The volatility is going to remain high, maybe a little lower from where it is right now. But this is what a bubble looks like. This is a classic commodity bubble and a very, very rare phenomenon to witness.
Oh, I get your words there, Amit. Unhinged, disconnected, and a bubble is what you're calling silver right now. But with the kind of run-up that we have seen in silver, markets anticipating that with China's silver export restrictions or the kind of very strong speculative money that has flown in, what do you think will move or blink first?
Manisha, I must point out here that in the last 3 days, silver has actually seen an outflow in ETFs. The last inflow that we saw in silver was on Tuesday and last Tuesday. And at that time, silver's price was still around $71. So in this entire rise of about, let's say, $9-10, we haven't seen any silver inflows in the ETF. So this is one. And secondly, of course, the immediate trigger for what we have seen in the last few days is this China deadline of January 1. But you know that they first came up with this idea of banning silver exports way back in November. So it was inevitable. It's just that we didn't know the precise date at that time. But this has been in the works now for about 6 to 7 weeks. I think I can also compare this with 99-2000 tech bubble, where even the slightest bit of good news was always exaggerated 10 times, and we saw Infosys, Wipro, and the K10 shares going up by like 10-20% in a jiffy. So this is what the price trend of silver has been like. But I don't think we've seen the end of it yet. And I don't think that today's top is the final top. That's not my base case. There is a probability that it may be the top, but there is a probability that in January we still might take that top again.
Amit, there are a lot of reports suggesting that $100 an ounce could be a probability in the first quarter of next year. What are you putting out as a range?
It is like predicting in December 99 what Infosys and Wipro would peak out in February, March. Nobody, even the most bullish of guys, could not put a finger to it. And the prices doubled even after December 99. So I'm not saying that silver's prices are going to double or anything from December's levels. But what I can say is that nobody can say with any certainty as to what the top is going to be.
Okay.
My base case is that we are going to take out today's top at some stage. And then maybe we go up to 90 or 92. Maybe we even go up to the magical number of 100. But I can assure you, Manisha, based on whatever we know about the financial markets, whatever we've studied over the last 500 years of the financial markets history, this is a classic bubble, and everything good. I'm not saying that there is nothing good about silver. We know, all of us know the good facts. You know, the deficits. It has been in deficit for last 5 years. We know about the demand for EVs, demand in photovoltaic
Right.
solar panels. We all know that. It's just that just 7 months back, silver was at about $32. And we have gone up parabolic after that. So it's not that all these factors.
I agree, Amit. I also do understand that it is a smaller commodity. It's $3 or $5 trillion there. And a lot of people, if they come together, can absolutely move this market. I just have one more question, Amit. If there is a correction, and as and when there is that correction, what is a very strong support that you see coming for silver?
See, if I talk about the current picture, I would say 70-71 is a very solid support, because that's the level we traded at a few days back. There was a bit of struggle there. So the immediate support, Manisha.
Okay.
And, I think this $70 to $84 range could persist for maybe a couple of weeks. But my base case is that once we have persisted in this range and it has traded enough in this range, there is a very high likelihood that we may take out 84, 85 levels, which were made in the morning today. So immediate support is, of course, 70-71, Manisha. But I must remind the viewers that when silver peaks out, and we don't know whether it has peaked out yet or it is going to make a higher peak in January end or February. But whenever it peaks out, it is just going to slice through all possible supports over the next few months, just like it just went like a knife through a butter, hot knife through a butter.
So what number are we looking at then?
See, as I have mentioned to you in the past, I still believe because this is a massive bubble, and whenever silver has been in such a massive bubble zone, it has never gone below 60% from the top. So whatever is the top, finally, it will go down by a minimum of 50 to 60% from that top, but that's not going to happen in a few months. That's going to probably happen over a year or maybe 1.5 years.
Okay, so what you are saying is that this might be the exceptional year where silver has risen 160%, 170%, and next year might see a steep correction?
I'm absolutely sure about it, that whatever is the top which is made between, let's say, now and February, we may have made the top today, but we may go beyond that. Whatever is the top that is made in the next 1 to 2 months, that top is not going to be broken in a very, very long time. So gold silver ratio today went down to 54. Now it was just 100. It was 108 just about a few months back. From 108 gold silver ratio coming down to 54 in just such a small span of time. I can just endlessly rattle the number of records which silver has broken in this run. So the Bloomberg greed factors, they are all at levels which are higher than 1980 levels. And we all know what happened after 1980. So this is absolutely a classic bubble, but nobody can put a finger as to what the final top is going to be and when it is going to be made. My guess is that the top is going to be in place by February of 2000.
That is when we need somebody to prick that bubble, perhaps. I mean, this is getting way out of hand.
Okay, all right. Well, quite a scary analysis there, because I'm sure a lot of people have put a large part of their assets into gold and silver this year in hopes that maybe that this kind of rally will continue. But Amit, thanks very much for joining in and taking us through that conversation. We're going to take a short break. We'll get back to equities, focus on Timex and Titan, which are reacting to news. Stay tuned.
Welcome back to Afternoon Report on CNBC-TV18. As of now, the Nifty is down 84 points in the trading session. Day's lowest point is what the Nifty 50 is trading at. 25,958, 959 is where the Nifty is at. So that is something that one should watch out for. Broader end of the market also continues to be under pressure in today's trading session. But let's talk about Timex. That has slipped in trade as the promoter launches an OFS to sell 9% stake. Vivek is joining us now to give us more details on this one. Afternoon, Vivek.
Well, good afternoon. Like we mentioned, Timex, the promoter entity, the MNC, is looking to further pare its stake in the company, and they're doing so once again by using the OFS route or the offer for sale route. So now the promoter entity, which is Timex Group Luxury Watches, remember, at the end of FY25, they had a shareholding of close to 75%. At the end of Q2, after paring stake of almost 15%, in June 2025, their stake dropped to close to 60%, 59.9% to be precise. Over the weekend, once again, they've gone ahead and launched an OFS further to pair close to 8.93% stake. This particular pairing of stake will be done via both a base as well as a green shoe option in case the company goes ahead and decides to exercise the green shoe option. Now, when you're looking at the floor price is at 275 rupees a share, which implied a little over 20% discount to Friday's close, which explains the kind of correction that the stock has seen today, given the fact that you can actually go ahead and bid at much lower rates to get the shares of the promoter entity. In terms of the stock performance for Timex, it's actually been an outperformer this year to 82% in 2025. From July 2025, from the previous office, up almost 63%. Revenues in Q2 higher by 40%. Margins expanded significantly, almost 300 basis points. H1-2 performance has been very strong. Revenues higher by 45%, EBITDA more than doubling when you're talking about H1 FY26, and EBITDA margins going up almost 500 basis points on a year-on-year basis. Strong financial performance, strong stock performance. However, the overhang continues to remain the fact that the promoter entity continues to pare stake.
Okay, all right. Thanks very much for that. So that's on Timex. But Titan has entered the lab-grown diamond jewelry market with its brand Beyond. And the first retail store is opening in Mumbai today. Sudarshan is here with all of the details. And what brokerages are now making of this move by Titan? Sudarshan.
So while market is trading in a range, one stock that is holding on to gains is Titan, and the reason is its entry or its foray into lab-grown diamond segment. And today, two brokerages have written, Morgan Stanley and Citi, with contrasting views. While Morgan Stanley welcomes its foray, Citi believes that it's unlikely to help or aid growth for the company. So Morgan Stanley maintains overweight call, and target here is 4,062 per share. It says while company was averse to entry into lab-grown diamond for the last 12 to 18 months, but finally it has entered into, and it's a step in the right direction. Citi believes that it has come as a negative surprise, and it is unlikely to drive any meaningful growth for the company or also to the earnings of the company, and foray may pose risk as it signals its admission of LGDs, that is lab-grown diamond, being a threat to natural diamond business that company is already into. So two contrasting views, but if you talk about the overall views, it's being taken positively, and that's one of the reasons why the stock is holding on to the gains.
Okay, Sudarshan, thank you so much for that. Surely we'll keep an eye out on Titan. But on that note, we're going to slip into a very short break. Up next, we'll get you expectations from the cement sector in 2026. Stay tuned in.
Welcome back. Well, 2025 was a pivotal year for the cement industry, which saw significant consolidation, but growth in demand could not keep pace with the expansion in capacity. But will 2026 bring good tidings for the cement industry? Nigel's here with more.
2026 could be a crucial year for the cement sector. The big question is whether the early green shoots in demand will strengthen or they'll fade away. Well, cement demand remained weak during October and November 2025, and growth during these 2 months was roughly around 6 to around 6.5% on a year-on-year basis. This compares with around 5.5 to around 6% growth that we saw in the first half of the fiscal. The slowdown was driven by three big factors. First, the sluggish government capital expenditure. Second, labor migration linked to the Bihar elections. And third, there were curbs on construction activity, particularly in the NCR region, due to the pollution-related restrictions. Birla Corp spoke to us here on CNBC-TV18 and they said that while demand was sluggish in October and November, early signs of improvement have started to emerge in December. The street is hopeful that demand will see an uptick in the fourth quarter of this fiscal that could be supported by higher government spending. Well, there was some pricing discipline and prices remained resilient between April to August 2025. However, the average pan-India prices declined by around 2 to around 2.5% in October as well as November. That compares with the average pricing that we saw in the second quarter of the fiscal. The impact was sharper in the non-trade segment, with prices falling by roughly around 15 to around 20 rupees per bag across regions, while trade pricing was softer by close to around 5 rupees per bag. The question now is whether a meaningful price hike can only be absorbed post the quarter 4 FY26. Well, consolidation in the sector appears to be largely behind us. The top 5 players account for around 62% of the industry, up from around 51% in 2020, and the share could rise to around 65% by 2028. However, the challenge is that the recently acquired assets are getting ramped up, which could lead to additional supply. In fact, the supply risk continues as capacity additions are expected to grow at a CAGR of around 7.5% to around 8%, while demand growth could be in the vicinity of around 6.5% to around 7%. This suggests that utilization levels will stay sub 70% for a prolonged period. And as large players continue to chase market share, mid-cap regional players may face greater pressure on pricing as well as on profitability. According to DAM Capital, large cement players are better positioned due to their diversified regional presence, the ability to gain market share without significantly affecting their profitability, and capacity to sustain capex momentum. They expect competitive intensity to remain elevated, benefiting large players over the medium term. Well, let's wind this down with a valuation snapshot of all our listed players. So 2026 is shaping up to be yet another important year for cement stocks. Whether green shoots on the demand front they blossom or they wither away, that will depend on the pace of the government spending, pricing discipline, and how supply additions are absorbed.
Okay, Nigel, thank you so much for the report card on what we should be keeping an eye out on in terms of the cement sector in 2026 and a wrap on 2025. But with that, we'll wrap up this edition of Halftime Report as well. Thank you so much for tuning in. Up next, your Business Lunch to take you through all the market action.